Have you ever placed a stop loss, watched price hit it perfectly, and then immediately reverse in your direction? Well, that's not bad luck. That's liquidity. And today I'm going to show you what a stop hunt really is, how whales hunt your liquidations, why breakouts fail, and how you can stop being hunted and start being the hunter. If you trade crypto, especially leverage, and you're learning it right now, this might completely change how you look at charts forever and help you become better at trading. The market does not move randomly. It moves from liquidity to liquidity. Large players like funds, market makers, whales cannot enter massive positions like you and me. If they want to buy 100 million Bitcoin, they need sellers. If they want to short big size, they need buyers. Where are those orders? Above equal highs, below equal lows, at obvious breakout levels, at support, at resistance. That's where retail places their stop losses and take profit targets. And stop losses become market orders when triggered. That's liquidity. The market moves to fill large orders. It hunts liquidity. In crypto, stop hunts are even more violent because of leverage. When you use 10x, 20x, 50x leverage, your stop isn't just a stop, it's a liquidation level. And liquidations create forced market orders. And here is an example. If price drops fast, long positions get liquidated. Their positions auto sell. That creates a cascade. And whales love cascades because they provide instant liquidity. That's why you see $500 million liquidated from the market in minutes. That's not chaos. That is structure. And it's a very, very simple structure. Let's start with the stop loss. What is a stop loss? Stop loss is an automatic order that closes your trade if price goes against you. If we buy right now Bitcoin at $65,000, we place our stop loss at $60,000. If the price drops to $60,000, your position automatically sells. Simple protection, right? A lot of people are looking to protect themselves. But the important part is when your stop triggers, it becomes a market order. That means it immediately buys or sells at the current price, and that creates liquidity. Now, what is a stop hunt? A stop hunt happens when price moves in an area where many traders placed stop losses. Big players push price there on purpose to trigger those stops, to collect liquidity, and then move price in the real direction. And if you look at the example here, Bitcoin has resistance at 70k level, let's say. Many traders go short there because 70k right now is also psychological level. A lot of people will try to short Bitcoin when it hits 70k. They place their stop losses at $70,500 level. Price spikes to $70,600, only $100 above people's stop losses. And that triggers all stop losses. Then price drops back to 69k. That spike was a stop hunt if it happens, and we see it happening right now. Now, the important question is, why is this happening? This is happening because big investors can't sell or buy huge amounts instantly. They need other traders on the opposite side. Your stop loss gives them that. The market moves to where orders are sitting, and many orders sit at obvious support, obvious resistance levels, equal highs, equal lows, and that's where beginners get trapped. So one important lesson here that you can take away is the market is not attacking you. It is searching for liquidity. If everyone sees the same level, expect price to briefly break that level. Like the 70k right now for Bitcoin. That's a major psychological level. So we can expect Bitcoin to break that slowly, hit all the stop losses, and then reverse. And then continue to the downside. If we want to go a little bit deeper, I want to tell you that markets operate as an auction. Large players need resting liquidity, imbalance fills, order absorption, stop losses cluster in predictable zones, above range highs, below range lows, above previous day high, below previous day low, above certain trend lines, below consolidation base. These are called liquidity pools. A stop hunt is technically a liquidity sweep. If we look at this chart here, just as an example, we have buy side and sell side liquidity. Buy side liquidity, you would see it abbreviated as BSL. That's located above highs. When price sweeps above highs, shorts positions close, we have then buying, breakout traders buy, stops convert to market buys. This fuels temporary upside movement. Then smart money sells into it. That's one. Then we have the sell side liquidity. That's located below lows. When price sweeps, longs stop out, and we have selling. Panic selling begins. Liquidations cascade and smart money absorbs and accumulates at that. And now I want to show you something else on the chart. We also have order blocks. They represent areas where institutional investors have placed significant orders, usually in the form of a range, as you can see on the chart. These blocks often precede a strong market move in the direction of the block, serving as a signpost for areas of interest to smart money. When the price returns back to the zone, it will often reverse. That's similar to an area of support and resistance. We also have breaker blocks. Breaker blocks are essentially failed order blocks. When an order block fails to hold the price, it breaks through, potentially indicating that the smart money direction has changed. When the price breaks above or below the order block, it can then act as a barrier for prices in the future. You can see here example of bullish breaker blocks. We also have something called break of structure. That's the concept that reflects a continuation of the current trend. It occurs when price surpasses a significant high or low, indicating a potential change in a market trend. It signifies the end of one market phase and beginning of another, offering clues about smart money's influence on market direction. And you can see here it's abbreviated as BOS, break of structure. And we have CHOCH, change of character. You can see break of structure and change of character. The change of character refers to alteration in the market behavior, often seen through an abrupt increase in volatility or a shift in price direction. As you can see here, we have change of direction and the market goes to the downside. It usually follows a break of structure, confirming a potential trend reversal and suggesting a new phase of market sentiment driven by institutional activities. We also have a fair gap value. The fair gap value is an area on the chart where price moves quickly through, leaving a gap that indicates an imbalance between supply and demand. Institutional traders often target these gaps for potential returns to fill them over time. So I want to show you now on this chart how you can identify the break of structure and change of character, and that would signal in which direction the market is going. A trend is typically recognized by a series of higher highs and higher lows. That's an uptrend, and lower lows and lower highs in a downtrend. Trend continuation is seen when there is a clear break of structure, where the price surpasses significant high or low, signaling a shift in market direction. Following this, a change of character, which is an abrupt change in market behavior, may confirm a new trend. Identifying these elements allows traders to align with the market's momentum, providing a strategic framework for setting a direction. If you can see here, we can see on the left hand side that we are sort of in a downtrend. Then we suddenly see change of character, which is signaling that basically surpassing the previous high over here in a downtrend, and that's signaling that now we potentially will go in a bullish trend. And we see that with the break of structure, we see new higher high over here, basically breaking above the previous high, and that's called the break of structure. Then we see new high over here, another break of structure, and the uptrend continues. Then suddenly we see red candles starting to pile to the downside, and we see breaking this previous point over here, and that's now change of character, signaling potential downtrend that is starting to form. We have gone below the previous low over here, and that's a change of character that we see. When you identify key supply and resistance zones, it is important then to look for candlestick patterns, hammers, shooting stars, engulfing candles, and you can download free patterns in the description of this video below to help you use that as a cheat list. So when you find specific candlestick patterns, these signal a possible continuation of the trend or reversal, and that helps you find your best entry place. If you look now at this example over here, I've got Swiss chart on, and this is my today's trade. I have identified that this zone over here is strong resistance zone. I can see that the price has tested that twice, and now it's the third time that it got tested. And I have this long wick, which is signaling that the previous liquidity has been swept. All the liquidity that has been piled at that zone, it has been now swept with this long wick. Price went up, it triggered all the stop losses that were sitting above this zone over here, and now is reversing to the downtrend. So my trade for today would look like, first I've identified the resistance and the supply zones, then I'm looking for the entry, and this candle here is my entry for the day. I would place my short position. I would use this level over here because I can see that's a major resistance level that we have failed to break above a couple of times, And this candle is my entry signal. So I would open a short position. I have my support over here where we've got strong support, and then I would place my stop loss just slightly above the candle wick. And I would execute this trade with 1 to 3 risk reward ratio. I could potentially even extend that further and keep taking profits with 1 to 3.5 risk reward ratio. That's just an example and how I am thinking as a trader. We tried multiple times to break through this resistance level. Now that's the third time, and I see this candle which is signaling that all the previous liquidity has been swept and we are likely now moving to the downwards. Here sellers are stepping in and I'm stepping in with them. That's just one example. Now I want to tell you something about the psychological component and all of this. Retail traders trade what is obvious. They place stops exactly at structures. They react emotionally, but professionals anticipate liquidity zones. They wait for a swap. They enter after confirmation. The mindset shift should be don't trade the level, trade the reaction to that level. This is what we are looking for. This is valid for traders. If you're a long-term investor, then stop hunts, they matter less. If you're holding spot, Bitcoin, Solana, SU without leverage, short-term sweeps, noise for you. But if you trade, stop placement becomes everything. Experienced traders often place stops beyond obvious liquidity. They reduce position size instead of tightening stops, and they enter after liquidity grabs. So on this chart that I show you for C, I would wait for the next candle to see, and I would enter upon that. And we need to use market structure shift confirmation. But if you're really starting now, I would say focus on buying on spot rather than trading. Trading is not as obvious and easy as it looks. The market moves to trigger clustered stop losses before the real move actually begins. And for beginners, this is difficult to spot at the start. You would need to start practicing on a demo account and always backtest your strategies before you actually start investing and trading. So that's for me today. Thanks so much for watching. I'll see you in the next video.